Welcome back to Prime Capital Insights, a channel focused on breaking down finance in a simple, beginner-friendly way so you can make smarter money decisions with clarity and confidence. In the last video, we covered how to start investing as a beginner, understanding risk, thinking long-term, and staying consistent. But now comes the most important question every beginner asks next. What should I actually invest in first? Most beginners don't lose money because they invest. They lose money because they choose the wrong first investment. And today, I'll walk you through a simple, step-by-step process to help you choose your first investment the right way, without hype, without guesswork, and without unnecessary risk. Before we continue, a quick reminder. This content is for educational purposes only and does not constitute personal financial advice. Always do your own research or consult a qualified professional before making financial decisions. Now, in the previous video, we talked about how to start investing as a beginner, understanding risk, thinking long-term, starting small, and staying consistent. Those principles matter no matter where you invest. But once you understand the basics, the next logical question is simple. What should you invest in first? That's exactly what we're going to break down in this video. Most beginners don't fail because they lack intelligence. They fail because they follow the wrong signals. One common mistake is chasing hot stocks or trending investments they see on social media without understanding what they're buying. Another mistake is copying friends, influencers, or headlines, assuming someone else has already done the research. And a third mistake is investing emotionally, panic buying when prices go up, or selling in fear when markets go down. These mistakes aren't about bad intentions. They happen because beginners don't yet have a clear process. So instead of guessing or reacting, what beginners really need is a simple framework. And that's what we'll start building next. Step 1, define your goal. Before choosing any investment, you need to define your goal. Not the product, not the platform, the goal. This is where many beginners go wrong. They start by asking, what should I buy? Instead of why am I investing? Your goal decides everything that comes next. Start by asking yourself a simple question. Will I need this money? If you're investing for the short term, maybe for something you'll need in the next year or two, the risk you can take is very different. Markets move up and down, and short-term investments don't have enough time to recover from volatility. But if your goal is long-term, 5, 10, or even 20 years, you can afford to ride out those ups and downs. Time becomes your biggest advantage. Think of it like a journey. A short trip needs a safe, direct route. A long journey allows for bumps, detours, and growth. So before you choose your first investment, be clear about your timeline and your purpose. When you know your goal, you automatically avoid many beginner mistakes, and investing becomes much simpler. Step 2, understand what you're buying. Once you're clear about your goal, the next step is simple. Understand what you're buying. This sounds obvious, but it's one of the most ignored rules in investing. Many beginners invest in things they don't fully understand, just because they hear about them online or see others making money. A simple rule to follow is this. If you can't explain an investment in 1 or 2 sentences, you probably shouldn't invest in it yet. You don't need to understand every technical detail, but you should know what the investment does, how it makes money, and what could cause it to lose value. Complex investments often promise high returns, but they also hide higher risks. For beginners, simple is powerful. Simple investments are easier to stick with, easier to learn from, and easier to manage during market ups and downs. So before you invest, slow down. Read, learn, and ask questions. Understanding your investment builds confidence, and confident investors make better long-term decisions. Step 3, beginner-friendly options. Now that you've defined your goal and understand the importance of knowing what you're buying, let's talk about beginner-friendly investment options. This is where many people expect a list of hot stocks or secret strategies. But for beginners, the best first investments are usually the simplest ones. Instead of trying to pick individual stocks, many beginners start with broad market investments. These are designed to give you exposure to a wide range of companies, rather than relying on the success of just one. One of the most common beginner-friendly options is index funds. An index fund simply tracks a market index, like the overall stock market or a group of large companies. You're not trying to beat the market. You're growing along with it. Another popular option is ETFs, or exchange-traded funds. ETFs work very similarly to index funds, but they trade like stocks. For beginners, the key idea is the same: diversification. Think of it like this. Buying a single stock is like putting all your money into one business. Buying an index fund, or ETF, is like owning small pieces of many businesses at once. This diversification reduces risk. If one company struggles, others may perform better, helping balance things out. That's why diversification is so important, especially when you're just starting. Beginner-friendly investments are not about excitement. They're about stability, learning, and consistency. You may not see dramatic gains overnight, but you also reduce the chances of dramatic losses. And that's a good trade-off when you're learning. Another advantage of these options is simplicity. You don't need to constantly track news, earnings, or market rumors. Broad market investments allow you to focus on the long term instead of short-term noise. As a beginner, your first investment is not about being perfect. It's about building experience, confidence, and discipline. Later, as you learn more, you may explore individual stocks or other investments. But starting with diversified, beginner-friendly options gives you a strong foundation. Remember, your first investment doesn't need to make you rich. It needs to teach you how investing works, how markets move, and how you react emotionally. And that lesson alone is extremely valuable. Step 4. Match risk with comfort. Now let's talk about something very personal: your comfort level with risk. There's no single best investment that works for everyone. The right investment is the one you can stick with, even when markets move up and down. If an investment makes you anxious, stressed, or constantly check prices, it's probably too risky for you right now. And that's okay. Being conservative in the beginning is not a weakness. It's smart. Your first investment should allow you to sleep well at night. Because when you're comfortable, you're more likely to stay invested instead of making emotional decisions. Many beginners fail not because their investment was bad, but because they panicked during normal market drops. Matching risk with comfort helps you avoid that. As you gain experience and confidence, your risk tolerance may increase. That's a natural process. But early on, stability matters more than excitement. So choose investments that align with your goal, your timeline, and your emotional comfort. The best strategy is one you can follow consistently, not one that looks impressive on paper. Step 5. Start small and learn. Finally, let's talk about how to actually begin. Start small and focus on learning. Your first investment does not need to be perfect. In fact, it doesn't need to be big at all. Starting with a small amount removes pressure and gives you space to learn without fear. Think of your first investment as a training ground. You're learning how markets move, how investments behave, and most importantly, how you react emotionally. Those lessons are far more valuable than chasing quick returns. Many beginners delay investing because they want everything to be perfect: the perfect strategy, the perfect timing, the perfect amount. But perfection often leads to inaction. Starting small allows you to take action today. Over time, as your confidence and understanding grow, you can increase your investment gradually. Experience builds clarity. Consistency builds discipline. And both together build long-term wealth. So don't wait for the perfect moment. Start where you are, with what you have, and learn as you go. If this video helped you understand how to choose your first investment, take a moment to like this video and subscribe to Prime Capital Insights. This channel is built to guide beginners step by step, without hype, without shortcuts, and without unnecessary complexity. In the next video, we'll break down index funds versus ETFs, what they are, how they differ, and which one might make more sense for you as a beginner. So stay tuned, and I'll see you in the next one.